All right, welcome back, ladies, to another episode of Economics. We are going to be talking about Chapter 5 today, which is Buying the Necessities. This chapter should have been super useful for your cost of living project. And most of this, I think you already know just from being consumers, but I'm going to review some of it anyway, and I'm going to throw you a few new terms too. Okay. So these are the big key terms that you are going to be reviewing in this chapter. Comparison shopping, club warehouse stores, convenience stores, private labeled products, coupons, store discount cards, lease, mortgage, equity, investment, closing costs, mortgage, subprime mortgage, and lease to buy, and liability insurance. Okay, first of all, starting with groceries. There are tons of different ways to get your groceries. You could do things like go to a club warehouse store, which would be somewhere big like Costco or Sam's. Those huge stores tend to have really good deals, but you have to buy everything in bulk. So if you have a tiny apartment, like I do, Costco could be super cost efficient as long as you have somewhere to store it, which I don't. So that's an important thing to think about. Convenience stores, on the other hand, are very, very convenient in that they sell only what you need, and they tend to be located in convenient places. And those are stores like 7-Eleven, or like a Quickie Mart or a corner store. Those are the type of places that mark up their prices slightly because you're paying for convenience in this case. Then you have something like private labeled products. Those tend to be groceries that come from grocery stores that are branded with their own brand. An example of that would be Safeway Select, or at Whole Foods, they have their Whole Foods brand. They tend to be a couple of cents cheaper than the national brand, and sometimes you might end up sacrificing a little bit of quality in favor for the cost savings, but that's something you have to investigate as a consumer to find out which brands you trust. There's also something called unit pricing, which is kind of nice. It's required by most states, and so you can comparison shop. Is it really better to buy the massive bottle of shampoo instead of the small one? Yes, it's 3 times the size, but is it only 2 times the cost? If it's just 2 times the cost, then you're probably getting a deal. If it's 4 times the cost, but it's only 3 times the size, then that doesn't make much sense, and it's probably not as good of a deal. Okay. Most labels, if you look closely, they'll tell you cents per unit, and that's something you want to pay attention to. Another way of saving money when it comes to groceries is with cents off coupons. Coupons are found anywhere from the internet to the newspaper to magazines to all sorts of places. Ladies, apparently you're all a big fan of extreme couponing. That would be an example of cents off coupons. So that's where buy one, get one free, or buy one, get one 50 cents off. And that would be a cents off coupon. There are also things like store discount cards. Store discount cards would be anything from a Safeway card, right? You plug in your Safeway number and the price drops, to a Sephora VIP card, something I know you guys or I think most of you are familiar with. And they use these store discount cards not necessarily just because they want to give you a discount, but often because they want to track your purchasing history. So they'll look back through that card and say, okay, we know a lot of information about this person because based on the types of goods that they're buying. So many people see this as a privacy violation, but since you are willingly signing up for the card, you are, if you read the small print, the fine print, you are willingly signing up for them to track your purchase history. Okay, clothes. Americans tend to care most about variety, style, durability, and the cost of care. Cost of care is something that I've just recently started looking at a little bit closer because I'm finding that dry cleaning is not only terrible for the environment, but it's also really, really expensive. Having said that, I know we're in a drought right now, so washing things is also not always the best option. But that's something you want to take into account, that it costs money to have clean clothes. Um, Durability is the ability of an item to last a long time, right? How durable is this item? For example, you bought your school skirt, right? You probably bought it your freshman year, and it's been a very durable item. You've worn it 5 days a week, or almost 5 days a week, for almost 4 years, your uniform skirt, and it has lasted you, hopefully, for all 4 years. So it's a very durable item. Some would maybe argue that it's also a very stylish item. Um, so service flow is the amount of use a person gets from an item over time and value a person places on this use. So for example, going back to your school uniform skirt, you bought your skirt, let's say it cost $40, but it lasted you 4 years. It was very durable. So you could divide that $40 by the 4 years and you would get your service flow per year, which is $10. Make sense? Okay, let's move on to housing. Okay, are you ready for this? The government advises that you should spend no more than 25 to 30% of your income on housing. Unfortunately, that's not so realistic in San Francisco, but hopefully wherever we all move to at some point, it will be more feasible. Or you'll be making tons and tons of money, and then it will be totally feasible for you to live in San Francisco. That's a good option too. Okay, so looking at whether to rent or to buy, there are pros and cons to each, and some of it's going to depend on your lifestyle and what you're looking for. To rent, one of the biggest pros is that you're not responsible for repairs or maintenance. You have greater mobility, meaning you get up and move technically at any time, or if you don't want to break your lease, you could, your lease is your contract. You could get up and leave at the end of your contract, and only the security deposit is required. If you compare that to a house is a lot more money up front is required, and renting is kind of a small change when you compare it to the costs of owning a house. One of the problems with renting is that you don't build equity, and I'll talk about what equity is in just a little bit, but you don't build, it's not as much of an investment, right? You live in the place, you live there for however long, and then you get up and leave, and you haven't, even though you've been paying rent for all that time, you don't have anything to show for it, really. The other problem is you also have less stability. If your landlord decides to change something about the house, to sell the house, then you need to move. And so it's not just up to you. Another thing is to think about is your neighbors and other members in the house. Those are all things to think about. Okay, sorry about that. Okay, oops. Sorry. You also, if you're looking at buying a house can have many income tax benefits. Often you get a credit on your income taxes, which can be very significant. You also build equity, a term that you might be familiar with from the reading, but we'll review. And it's a very good investment, often is a good investment, and it tends to be much more stable than renting. Some of the biggest cons include repair and maintenance costs, and you need to have a big chunk of change up front. You usually tend to put down at least a 20% down payment. So if your house costs $100,000, that's a big chunk of change to think about. Okay, so renting, you have a lease, which is your contract. Your lease is usually month to month, but it can be a year-long lease. Sorry, I should change that. It can be a year-long lease. It could be month to month. It could be 6 months. You have to look at the terms. Usually when you're applying for an apartment, and say you get the apartment, the landlord likes you, and chooses you to rent, then you usually have to put down the first month's rent and a security deposit. If it's a really nice place, you should probably expect a bigger security deposit. The nice thing is that you get it back if you take good care of the apartment. So if you leave the apartment in terrible shape, excuse me, the landlord probably won't give you back your deposit, but if you leave it in pretty good shape, you'll get it back. And then what's nice is often you can use it then, if you're renting again, you can use it towards the next security deposit. You always, always, always want to read the fine print. Sometimes there are small little clauses in there that you might need to pay attention to. If you notice weird things, bring it up to the landlord or have a parent or even a lawyer look at it. It's always good. You need to know what you're signing. You never sign anything without reading it first. Couple things. You as a renter have rights. The landlord is never allowed to enter your place without explicit permission first. Usually 24 hours is required. And if you're interested in learning more about renters' rights, it usually varies by city and county. So it's important for you to check and find out wherever you are. But it's great because they have lots and lots and lots of information, usually online. Not every place has it, but major cities tend to. Okay, also, your landlord must maintain a habitable space. So if you find that there is mold growing on your ceiling, that, at least in San Francisco, you bring it up to your landlord and you ask them to remove it because that's not a habitable space, right? That's not hygienic. Your landlord may not enter your apartment without your permission, but you as a renter also have some rights or also have some responsibilities, and they include paying your rent on time, and you also maintain the apartment. That's part of what you sign up for. One big thing to note, in college, I know this is a big thing, but you may not have more people in the apartment than on the lease. Technically, that's grounds for them to kick you out, to evict you. And you don't really want that. So you can't have 2 people on the lease and then have 5 people living in the apartment. And I know that's popular in college, so be really careful with that. Okay, if you're buying a home, equity. Equity is a term that refers to the value of the home minus the mortgage left. Okay, so equity equals the value of the home minus the mortgage left. So if you have a house worth $1 million and you put down $200,000 and you took out a mortgage for $800,000, your equity would be $200,000. Does that make sense? Rewind it and replay it if you need to hear that example again, or we can talk about it more in class. Houses are an investment. They appreciate in value. So over time, as you make small improvements to a house, their value increases. And that's really important. Another term you need to know is closing costs. Closing costs are the costs for arranging the mortgage and transferring ownership. Often people forget about these costs, and then all of a sudden you think that the house costs $1 million and you find out that it actually really costs $1,200,000 because that didn't include all of the closing costs. So if you ever buy a house, you always want to make sure that you're budgeting for that additional cost as well. All right, a mortgage. What is a mortgage? A mortgage is a loan from a bank to pay for the house. Usually, you put down at least 20%. If you can put down more, that's always better. But then your mortgage each month should not be more than 1/3 of your income. Okay, right? Because remember, going back to the statistics, no more than 25 to 30% of your income should go towards your housing each month. So you don't want to take on a mortgage that you can't afford. That's what happened in the housing crisis back in 2008, 2009, 2010, where people sometimes, we talked about it in class, sometimes they signed up for a mortgage that they thought was one rate, and then it skyrocketed and it became much more, sometimes 50%, 60% of their income, and it became very unaffordable. I'm going to show you a quick video about that, a short 5-minute video. Another thing to know about is points. Points are fees paid to the lender, which are computed as a percentage of the loan. Each point the lender charges equals 1% of the amount borrowed. So that's important to know when it comes to mortgages. Okay, subprime mortgages.
What happened is...
Okay, this is a brief video about deregulation and the subprime explosion from now Senator Elizabeth Warren. At the time, she was a professor at Harvard Law School, but she has some great information here.
In the early 1980s, we had almost at the same time, within months of each other, the credit card industry was effectively deregulated by the Supreme Court, and the home mortgage lending industry was deregulated by Congress. Now, what's interesting about this is the usury caps were effectively erased with no public policy debates, no discussion about...
Very quickly, remember back to Chapter 4, usury rates. State usury laws were the laws that put limits on how much interest lenders could charge on credit. Okay, so don't forget that. Remember that.
Effectively erased with no public policy debates, no discussion about what the real implications would be. And
can I ask you a question? You may not know the answer, and it's not directly relevant, but it's humanly interesting. Wasn't that the case that was argued by Bob Bork in favor of the credit card on the side of the credit card industry after he was Solicitor General?
Now, I don't know on this. Marquette is the decision in the United States Supreme Court that effectively deregulated. So I don't know if Bork was involved in it or not.
Go ahead. I interrupted you, so go ahead.
No, that's all right. He shouldn't have been, because it should have been before Bork was Solicitor General. But we could... I'm trying to think what the years would do.
I think he argued on the private side, but I could be wrong.
Anyway, what happened is they deregulated so that credit card companies, mortgage lenders could charge whatever they wanted. A few years go by, because you may remember in the early 1980s we have very high inflation rates. We're just beginning to deregulate.
19% for a while.
That's right. Yeah. Beginning to deregulate the savings and loans. The banks are becoming a little more competitive. And then, starting in the early 90s, a new industry is born. Again, very quietly, but it's known as the subprime industry. And that's the part of the lending industry that doesn't do the old-fashioned kind of lending. That is, they look at someone like Elizabeth Warren and they say, we think she'll be able to pay back without any difficulty, and therefore we'll lend to her at whatever is the interest rate that they think reflects risk and the possibility of inflation. Instead, what happened is they said, someone from whom we could make really good money is not to lend to that Elizabeth Warren because she pays back on time and in full. It's to lend to her nephew who doesn't have an income yet, who's a college student, who is sporadically employed. Let's lend to him and count on the fact that he'll make minimum monthly payments, and he may even occasionally skip a payment. And if he's already built up some debt by the time he skips a payment, we could jack up the interest rate on that. And that may improve our overall profit.
You mean if there's a higher interest rate when they're charging interest on interest than when they're charging interest on principal?
Well, and a higher interest rate, even though you borrowed the money back at 8.99%, it turns out that most credit card contracts are written today so that the credit card company has an unfettered ability to change the interest rate. So the interest rate may be changed because interest rates change generally in the country, but it may also be changed because you missed a payment, because you went over limit, because you missed a payment on another bill, and that changes your credit report, and so they change the interest rate, or because you applied for a credit card somewhere else, and the current company found out that you applied for another credit card, and that changes your credit score, and so they up your interest rate. And what the credit card companies discovered is the profits to be made from lending to people who make minimum monthly payments, who pay for a while and then skip a payment, miss a payment, fall behind. That's where the real profits in the industry are to be made. I'm not a very profitable customer because I do pay in full on time. 85% of the revenues from credit card companies come from interest payments from people making those low minimum monthly payments, and from fees. Indeed, companies have figured out.
What are the fees?
Fees are everything from your annual fee, which has actually been going down because people like me don't want to pay it, to the fee if your check doesn't clear, to the fee if your bill arrives one day late, your payment arrives one day late, if you go over the credit limit on your card. Fees were about $1.7 billion in 1998. That's what credit card companies collected. Last year, they collected more than $10 billion.
This excerpt is brought to you by the Massachusetts School of Law, the leader of reform.
Okay, so hopefully that was very helpful. I found it incredibly insightful and felt that it really connected to the article that I had you guys read from The Economist in class last week. Okay, moving on to cars. Buying and operating a vehicle. The big question is new or used, right? So you have to make that big decision. You also need to take into calculation the registration fees. These can range. Some of you found when in your cost of living project that they were really low. Some others are much higher. It depends on your car age, your weight, the car weight, the car type, and the value of the car. Many cars also have something called an extended warranty, but that tends to be only for newer cars. That means that if it's under warranty, that they will pay for certain repairs until it usually hits a certain mileage or an age limit. Right? So say 30,000 miles or 2 years, whichever comes first. Also, depreciation is something you have to think about. A car loses value the second you drive it off the lot. So if it's $20,000 when you drive it off the lot, the second it's off the lot, it could go down somewhere as much as $5,000. And then you could try to resell it, but you'll never get that full value. So that's something important to think about. You also need to take into account your costs, normal maintenance and repairs, which can really, really add up. It depends on the type of car, of course. Leasing a car. Leasing a car is another option for getting a car. It's where you rent a car for a longer period of time. They range. It can be 1, 2, 3, or even 5 years. But there's often restrictions on mileage and damage to the car that kind of go along with that. So usually it's something like you can't go over 60,000 miles, which is a lot of miles. But if you go over, then they start charging you something like $1 per extra mile, which really adds up quick. Same thing with damage. If there's a ding on the car or if you get into an accident, then this is not a good investment for the company that was leasing the car to you, and they can ding you there as well and charge you some pretty exorbitant fees. The good news is that the dealership often pays for some of the maintenance, and that you can often get a newer or a fancier model. It might make a newer or fancier model more affordable because you're not really buying the car outright. At the end of your lease time, you give the car back. So for example, you could rent a Mini Cooper for something like $200 a month. But at the very end of the whatever time period you rent it for, 2 years, 3 years, 5 years, whatever it is, you give the car back. So you wouldn't own the car. So you've been paying this money towards a ut but you don't actually own it. So to get around that, some places have something called lease to buy. Lease to buy means you rent the car for a period of time and you put your money into it. And then at the end, you have the option. You can either give the option of returning the car or you could purchase the car. So that's another option. Okay, car insurance is another big thing, and that's a huge cost as well. Your book talked about liability insurance, which is insurance that pays for bodily injury and property damage, but I thought that this additional video about car insurance was really helpful. I actually talked to my amazing car insurance agent, and he sent me this video and said that I was more than welcome to share it with you guys. So this is from myagencyvideos.com. So here you go.
We've created this brief video to help you better understand your auto insurance options. So let's start out with the basics. The first type of auto coverage is what's known as liability insurance. This coverage can help pay for the damage if you are legally responsible for accidentally injuring someone, or for damaging another vehicle, or other property in an auto accident. Auto liability coverage falls into two categories. First, there's bodily injury liability. This covers medical expenses, pain and suffering, lost wages, and other special damages. The second category is property damage liability. This covers damaged property. For example, it would cover the car that was involved in the accident, or if you hit a lamp pole or house. So you're probably aware that in most states, drivers are required to carry a minimum amount of liability coverage in order to register their vehicle or obtain a driver's license. And each state has its own minimum liability coverage limits. For example, the limits for California are $15,000 per person, $30,000 per occurrence, and $5,000 for property damage. So what this means is that if you are in an accident where you are found to be at fault, your insurance company may pay up to $15,000 for any one person's injuries in the accident. And the maximum that they will pay is $30,000 for that accident, or what is also commonly referred to as per occurrence. So to clarify, with these minimum coverage levels, no one person will receive more than $15,000 for bodily injury. And the insurance companies will only pay out a maximum of $30,000, regardless of how many people are involved in the accident. The second component of this liability coverage is the $5,000 for property damage. This will pay for the other person's property. So if you're in an accident and you hit someone else's car, your insurance company would spend up to $5,000 on your behalf to have the damaged car fixed or replaced. So you may be thinking to yourself, $5,000 to replace a car? Or $15,000 to cover injuries? Well, in a different video, we discuss some guidelines for selecting the appropriate auto insurance coverage levels and take a closer look as to why the state minimum coverages may not be enough. So one last point about liability insurance, because this seems to cause a bit of confusion for people. Liability insurance only pays for the other person's injuries and damages to their vehicle. If you only have liability insurance in place, you'd be forced to come out of pocket to cover the expenses to fix your vehicle and your medical expenses. The next series of coverages aren't required by law, but as we review these, you'll see how each of these coverages can be very important to protecting you and your valuables. First, let's talk about uninsured, underinsured motorist liability. This type of coverage is in place to protect you or your passengers that are hurt as a result of another driver's negligence, even when they don't have insurance. That's right, uninsured motorist coverage acts like the other driver's insurance and addresses your injuries and property damages up to the limit of your uninsured motorist coverage. So you may be asking yourself, why is it a good idea to have uninsured motorist coverage when it's mandatory for all drivers to have insurance? Well, the answer is simple. According to the Insurance Research Council, 15% of drivers have no insurance, and another 30% don't have enough. So that's why uninsured motorist coverage insurance is a great way to make sure that you and your family have coverage in place, even if the other driver has little to no insurance. The next type of coverage is what's known as comprehensive coverage. This type of coverage protects you from losses that result from fire, theft, falling objects, riots, storms, earthquakes, floods, and even when there is a collision with a bird or animal. And another way to think of comprehensive insurance is that it applies when there's no accident involved. Comprehensive coverage can also include car theft insurance if your vehicle is stolen or vandalized. It's important to note that comprehensive coverage is normally required if your vehicle is leased or financed. The next type of coverage is collision insurance. This type of insurance pays for the damage to your vehicle resulting from an accident where you are found to be at fault. So earlier we discussed liability coverage. That's the coverage that pays for the other person's vehicle when you are at fault, whereas collision coverage would pay for damage to your vehicle, even if you are found to be at fault. The next type of coverage is medical coverage. This coverage can help pay for many medical expenses that may not be covered by your existing medical insurance plans. It can also provide coverage for you or a family member when riding in someone else's vehicle. Next up is our towing and roadside assistance service. With this coverage, you'll get emergency roadside assistance 24 hours a day, 7 days a week. This coverage provides assistance if you need a tow, you lock your keys in your car, you get a flat tire, or a dead battery. In some cases, this coverage will be included in a comprehensive policy. The next coverage option is for loss of use, or this is sometimes called rental car coverage. This coverage can help you cover rental car costs or other costs for transportation. Most carriers offer different levels of daily limits and overall maximum coverage levels for you to choose from. Next up, glass deductible buyback add-on. This coverage can help replace your windshield after you pay a small deductible, and in many cases, repair.
Okay, Okay, so it gets into the much smaller types of insurance, but I thought that the video was very useful in covering additional types of insurance outside of just liability insurance. Okay, so we are going to pause with chapter 5 right there, and I will do a separate video for chapter 6. Thanks for tuning in.